Hello guys, welcome back to another trading video. In this one we're going to be walking through standard deviations and how you can use them to kind of predict levels and all of that, and also if you don't have access to standard deviations but instead watch my videos on how you can what you expect to happen around these levels, because we have had quite a lot of new people to the channel recently. Some people have been asking questions, so I thought it just makes sense to throw it into a video, and then you could probably get a better understanding of how it works. So we'll go over a few different stocks just to kind of make it clearer, and we'll start this off on DKNG. So for this we won't be looking at any gap fills, and we'll instead only be looking at standard deviations. So what we always do, and we would do in the video, is mark all our deviations. Actually, you don't even have to do them all, but maybe all the ones that we are currently close to. So we will mark these deviations for the time being, because these are kind of the ones we are close to at the moment. And then what you would want to do is currently see where is the current price. So currently we're at $43. What you then want to be looking at is, okay, where is or what level are we coming into? And we can see this 45.30 we've already broken through. So what you want to see is if you've broken through a level, that it's going to come back and retested it. And so for example in DKNG we can see it broke through here on Thursday, pulled back and retouched it on the Friday before continuing down. This is what you want to see if the trend's going to continue down, because more likely than not, if it breaks straight through the level, and especially in this case where you don't get a bounce at that level, you expect it to break through, retest, and then more likely than not it will continue down. So that's the first thing you want to do. If you see it break through a level, you want to see it retest, and then if it continues in the direction, then it's most likely going to continue in that direction. So in this case it's going to continue downwards more likely than not. Then you look, where is your next price level, and in this case that will be at $40.50. So what this tells us is that now DKNG is come back, retested, and is now continuing down. So that means our next price target to the downside will be $40.50. So as that's our price target, if we were short, it would be an area we were looking to lock in profits. And as it's one of these bottom deviations, it can also be considered a buy zone if you're looking to get long on DKNG. So when it comes down to this $40.50, depending on how you're trading, this can be a long trade for you. And that's personally how I would be trading it. I wouldn't have been short at 45, but I would instead be looking to get long at $40.50. But like always, you need to be risk managed. And how can you use standard deviations to be risk managed? The easiest way to do it is look, where is the next deviation? That can be a half or full, because you can use this in two ways. Firstly, you'll see our next one, if we're getting long at 40.50, we can see the next deviation is at 38.50, and that's a full deviation. So the way we would use this is get in with some size at 40.50, get in with some more size down at 38.50. So what this will do is give us an average cost at say around 39.50, and then it means well, this just means, yeah, this will be where our average cost is. And the reason we get in with usually half size when the deviations are that close is it allows us not to be instantly correct, because the problem is if you're getting long at say $40.50 and it pulls back 5% to that next level, more likely than not you would get stopped out if you don't really have some sort of an average. Whereas if you're averaging in, by the time you get down to 30.50, you're only really down, if we average that out, you'd be down much closer to 2.5%. So depending on your then risk management from here, you'll most likely be able to manage the stock to go down a bit further. So you're less likely to kind of get stopped out if you're able to average into the position. So that's the first way you kind of use the levels. And then how do you find maybe a good area to stop out? The way I usually do this is looking at half deviation. So I usually go onto, so let's say I get long at this 40.50, that is the first deviation on the 4 hour. So more likely than not, my stop will be the half deviation on the 4 hour as well. So this 36.60 level is the half deviation on the 4 hour, So my stop would be going a little bit below that. So depending on your own criteria, I may have my stop at say 36.35, so it gives it a bit of room to come into that psychological 50 cents, so the 36.50 level, and bounce. Or if you are happy to take on that bit more risk, you could have your stop closer to say 35.85, and then it gives you the 36 whole dollar psychological level to kind of bounce off and hopefully turn in your favor. Again, you can do your stops in different ways depending on how you prefer to trade. Some people may have a stop at say just below $38, so you're not looking to take on too much risk, but you have to kind of have the immediate bounce, and that will work sometimes, but obviously you will get stopped out more. So it's just creating a plan that's more comfortable for you, and that's why when I'm doing the standard deviation videos or the analysis videos, I say use these levels depending on your strategy, because we will all use them differently depending on your style of trading, your risk management, whether you're a short bias trader, long bias trader, or you don't really care what side you're going. You're all going to have different plans, and that's why it's good to understand these levels and how they react, and then depending on how you trade, you can use them in different ways. So that's kind of the overall gist of standard deviations. We'll go and do it on one more stock, just in case that wasn't clear. And for this, I guess we could use, say, plug, because this has been reacting quite heavily recently. So we'll go through the same exact thing, because I think I did an analysis video on this a few weeks back, and it ended up playing out quite accurate. So same kind of thing. We see plug is currently pushing high, pushing close to that third deviation on the 4 hour and the first deviation on the daily. So the first thing we're going to want to do is place our support and resistance lines, which is coming close to the current price. So for now, that would kind of just be these levels of the very close ones. So then what we can do is just go on to a we've just gone to a clean chart. You don't have to do this, it's just it's going to be easier for video purposes. So we will actually even get this to a longer duration. So this 32.60 level, you can see obviously we traded it back here, we broke through, tested it, and you'll see it came back, tested this level, didn't really go too far below it before continuing to that next deviation. And in this case we then broke the 38.90, but what you'll see is we never touched this level, we gapped through. So what you would be looking for is the retest of this level as a long, or you can use it as a long bias buy point. So you'll see that it did push up higher, finally pulled back, and then you'll see it touched the level before getting a strong bounce. In this case, it doesn't look like it's going to go into an all-time high, but it did push off quite a lot of percentage, near 6%. So more likely than not, you would have locked in some sort of profit on that way, or at least move your stop. So no matter what, it still should have been a winning trade. And depending again how you use them, swing trading, day trading, if that was a day trade, you would have made an easy, quick trade, high profit. If it's a swing trade, depending on what your price target was, you may have got out break even, bit of profit, and if you for some reason didn't move your stop, might turn into a loss. We don't really know yet. But that's why, again, you'll see I do say in videos quite a lot, when it comes into this level, move your stop. And how do I usually justify moving my stop? I tend to use half deviations, more likely than not, or psychological levels. So in this case, we had a half deviation at 91, and you can see it didn't quite come into that half deviation. So it may have mean, if that's where you were looking to move your stop to break even, that you never did move it. But you can also look at kind of where's resistance and a psychological level, and in this case you can kind of see the $41 level had quite heavy resistance here on this day, again struggled on that day, and then you'll see that's where it struggled on this move here. So again, depending on how you justify stops, we'll go through all the ways you can kind of calculate them, or at least how I look to do them, and then you can pick your own plan. So again, you could use a half deviation. In this case, wouldn't have worked, but it won't work as much as looking for a psychological level, but it will mean that your wins are bigger when you do get them. But if you are someone who looks for kind of where resistance is for the previous few days, you would have got a level of around say $41 to $41.25, and those are both psychological levels. So if you use that as your stop, or an area to lock in profits, or move your stop to break even, you would have been fine on this trade. You would have either made a profit or stopped at break even. Then you'll see we've broken back below now in current time, below 38.90. So what this means is we haven't yet retested this level, so we would be expecting, let's make sure we actually plotted this accurately. Yeah, 38.90. So we haven't yet tested this level again. So we would be expecting maybe on Monday for markets to open up, we retest this $38.90. And then if it's going to continue down, it can do from there on. And then we would be having a price target short all the way down to 32.60. So again, this is kind of how you use the deviations. You're looking for moves from deviation to deviation. You just need to make sure that you're risk managed, and you can trade these levels kind of how you want. If you're short bias, long bias, it doesn't matter. You just kind of need to know how it reacts. If it breaks through a level, you expect it to come back and retest it, and then carry on. And again, if it's broken through a level, you expect it to get to that next whole deviation. That's usually how we look to trade these. So you just want to have your own risk management, because that's the only thing I can't really do for you. You kind of need to have your own plan. We all have different risk tolerance, so you just have to make sure you have your own risk in place, and then everything should be good from there on. So I hope that explains how the deviation's a bit better. If you do have any more questions, just post them in the comments and I'll get back to all of them. Hope to see you in the next one, and that's it. Peace.